Question. A, B and C were partners in a firm sharing profits and losses in the ratio of their capital. C decided to retire and remaining partners decided to share future profits equally. On the date of C's retirement, their balance sheet was as follows. Balance sheet liabilities, capital accounts A 30,000, B 40,000, C 50,000. General reserve 30,000, sundry creditors 40,000, bills payable 10,000. Asset side, land and building 1,20,000, plant and machinery 50,000, sundry debtors 20,000, stock 10,000. Balance sheet total 2 lakhs. Additional information, the goodwill of the firm was to be valued at rupees 1,20,000. Land and building were to be appreciated by 15%. Plant and machinery were to be depreciated by 10%. Provision for doubtful debts was to be created at 5%. Unrecorded assets were to be sold for rupees 12,000. You are required to prepare necessary ledger accounts and new balance sheet of the reconstituted firm. Working notes. Calculation of gaining ratio. Old ratio on the basis of capital 30,000 is to 40,000 is to 50,000. That is 3 is to 4 is to 5. New ratio 1 is to 1. Gaining ratio equal new ratio minus old ratio. New share of A 1 by 2 and old share 3 by 12 equal 3 by 12. 1 by 2 minus 3 by 12 equal 3 by 12. B, old share 1 by 2, new share 1 by 2, old share 4 by 12. Gaining ratio 1 by 2 minus 4 by 12 equal 2 by 12. Gaining ratio 3 is to 2. Next, adjustment of goodwill. Goodwill of the firm is given, that is rupees 1,20,000. Goodwill of the firm is valued at rupees 1,20,000. Retiring partners' share of goodwill equal goodwill of the firm into retiring partners' share in profit. Goodwill of the firm is rupees 1,20,000 and retiring partners' share is 5 by 12 equal 1,20,000 into 5 by 12 equal 50,000. C's share of goodwill is 50,000. That is the total amount of compensation receivable from the continuing partners. Compensation payable by A 50,000 into 3 by 5 equal 30,000. B 50,000 into 2 by 5 equal 20,000. Next, a revaluation account. Adjustment number 2. Land and building were to be appreciated by 15%. Book value of land and building 1,20,000, which is appreciated by 15%. Land and building appreciated by 15% means value of land and building increased by 15%. Amount increased is 18,000. Increase in value of assets are credited to revaluation account. So, revaluation account credit side, land and building 18,000. Next, third adjustment, plant and machinery were to be depreciated by 10%. Depreciation of plant and machinery 10%. That means plant and machinery reduced by 10%. Book value of plant and machinery 50,000. Amount decreased is 5,000, which is debited to revaluation account. Next, fourth adjustment, provision for doubtful debts was to be created at 5%. Amount of debtors given in the question rupees 20,000. Provision created against debtors. Provision for doubtful debts 5% of 20,000, that is rupees 1,000, which is also debited to revaluation account. Next, unrecorded assets were to be sold for rupees 12,000. Unrecorded assets are credited to a revaluation account. Amount realized from unrecorded assets rupees 12,000, which is credited to a revaluation account as cash account, because the amount received through the sale of unrecorded assets are rupees 12,000. Next, balancing of revaluation account. Balancing figure 24,000. Balancing figure 24,000 on debit side means gain on a revaluation, which is transferred to partners capital account. A's share 24,000 into 3 by 12 equals 6,000. B's share 24,000 into 4 by 12 equal 8,000. C's share 24,000 into 5 by 12 equal 10,000. Next, partners capital account. Partners capital account credit side, first item, balance brought down, that is the opening balance of capitals. Capitals are 30,000, 40,000, 50,000 by balance brought down. Next, general reserve, that is the reserve transferred from balance sheet. 30,000 is the amount of reserve given in the question, which is distributed among the partners in their old ratio. A's share 7,500, B's share 10,000, C's share 12,500. Next, revaluation account, that is the gain on revaluation transferred from a revaluation account. A 6,000, B 8,000, C 10,000. Next, compensation. Compensation payable by A 30,000, B 20,000. Look at the debit side of partners capital account. First account to C's capital account, rupees 30,000 in A's column and 20,000 in B's column. 30,000 is the compensation payable by A and 20,000 is the compensation payable by B. That's why these two amounts are debited to A's capital account and B's capital account. Next, capital account credit side, C's column 30,000 and 20,000. That is the compensation receivable by C from A and B. Next, balancing. First, we have to balance retiring partners capital account. Retiring partners capital account, balancing figure 1,22,500, which is transferred to retiring partners loan account. Look at the debit side of partners capital account. Second item to C's loan account, rupees 1,22,500. That is the total amount payable by the firm to C at the time of C's retirement, which is transferred to C's loan account. Next, balancing of capital accounts of continuing partners. Capital balances: A 13,500, B 38,000. Next, balance sheet. Balance sheet. Liability side, capital accounts: A 13,500, B 38,000. That is the capital balances as per capital accounts of partners. A's capital 13,500, B's capital 38,000. Next, C's loan account 1,22,500. That is the amount payable to C. Next, sundry creditors 40,000, bills payable 10,000. Asset side, land and building 1,20,000 plus amount increased 18,000. Present value 1,38,000. Plant and machinery 50,000 less depreciation 5,000. Present value 45,000. Sundry debtors 20,000 less provision for bad debts 1,000. Present value 19,000. Stock 10,000. Cash 12,000. That is the amount realized on amount realized through the sale of unrecorded assets. Adjustment number 5. Unrecorded assets were to be sold for rupees 12,000. Since it is an unrecorded asset which is credited to revaluation account as cash account. Rupees 12,000 is the amount realized, or rupees 12,000 is the amount received through the sale of unrecorded assets. Next, balance sheet total 2,24,000.